The acceleration of China's efforts to diminish the US dollar's global dominance is unfolding at a critical juncture, where geopolitical frictions intersect with economic vulnerabilities. Recent policy initiatives from Beijing, including expanded renminbi internationalization and bilateral trade agreements in local currencies, are eroding the dollar's entrenched position in international settlements. This shift matters profoundly now, as it coincides with U.S. fiscal challenges, including escalating debt levels and reliance on foreign capital inflows. The implications extend beyond bilateral relations, potentially destabilizing global commodity markets and amplifying volatility in currency exchanges. Hidden within this transition are risks of fragmented financial architectures, where reduced dollar liquidity could precipitate crises in dollar-dependent economies. As these dynamics intensify, stakeholders must confront the erosion of American economic leverage, fostering an environment ripe for strategic miscalculations and broader systemic disruptions. In the evolving landscape of global monetary dynamics, China's concerted efforts to elevate the renminbi's prominence in international trade and finance represent a pivotal shift that demands immediate scrutiny from economic intelligence perspectives. As of December 26, 2025, Beijing's dual circulation strategy, which emphasizes bolstering domestic economic resilience while selectively engaging with international markets, serves as the foundational framework for these advancements. This approach, initially articulated in response to heightened external pressures including trade frictions and financial sanctions, systematically integrates renminbi-denominated mechanisms into cross-border activities. Recent data from the People's Bank of China indicates that cross-border renminbi receipts and payments reached RMB 35 trillion in the first half of 2025 alone, marking a 14% increase year-on-year, with RMB 6.4 trillion directly tied to goods and services trade. Such figures underscore a deliberate policy trajectory aimed at reducing dependency on traditional dollar-centric systems, thereby fortifying China's position amid escalating geopolitical tensions. The strategy's implementation involves nuanced adjustments to currency baskets used in trade settlements, where the renminbi's weight is incrementally enhanced to reflect China's growing share in global commerce, now accounting for over 15% of world trade volumes. This not only streamlines transaction processes, but also aligns with broader objectives of economic autonomy, as evidenced by the expansion of offshore renminbi hubs in locations such as Singapore, London, and Hong Kong, which facilitates smoother capital flows without necessitating full capital account liberalization. Delving deeper into the mechanics of these policy measures, the dual circulation paradigm has catalyzed a surge in trade credit extensions denominated in renminbi, a tool that extends beyond mere financing to embed the currency within international supply chains. By October 2025, trade credit as a proportion of China's exports had risen to approximately 2%, a modest yet significant uptick that aligns with historical trends observed since the 2010s when Beijing first piloted renminbi internationalization pilots in select free trade zones. This increment is not isolated. It is part of a broader ecosystem where adjustments to multilateral currency baskets, such as those employed in the Belt and Road Initiative projects, prioritize renminbi settlements. For instance, partnerships with countries like Brazil have seen accelerated adoption of local currency settlements, bypassing dollar intermediaries entirely. In 2023, Brazil and China operationalized bilateral trade agreements allowing importers to settle in renminbi or reais, with settlements processed through domestic financial infrastructures, thereby reducing exposure to exchange rate volatility and external sanctions. Similarly, trade with Russia has reached unprecedented levels, with over 95% of bilateral transactions conducted in local currencies by 2024, culminating in Russia's issuance of its first sovereign bond in renminbi in December 2025, a RMB 3 billion deal that attracted robust interest from Hong Kong investors. These developments are facilitated by China's cross-border interbank payment system, CIPS, which has expanded rapidly to handle renminbi transactions independently of SWIFT processing volumes that now rival established networks and enhancing liquidity in offshore markets. The strategic intent here is clear. By promoting renminbi usage in commodity trades, such as Brazil's soybean exports to China, which constitutes 70% of Brazil's total soybean output, Beijing is weaving the currency into the fabric of global resource flows, thereby diminishing the dollar's role in pricing and settlement. Geopolitically, this progression constitutes a calculated countermeasure to vulnerabilities inherent in the dollar-dominated financial architecture, informed by historical precedents of U.S.-imposed restrictions. China's experiences with sanctions on entities like Huawei and restrictions during the 2018-2020 trade disputes have underscored the risks of over-reliance on dollar-based clearing systems, prompting a pivot toward renminbi-centric alternatives that insulate key economic arteries. The establishment of renminbi swap lines with dozens of central banks, including those in BRICS nations, exemplifies this resilience-building effort, providing liquidity buffers during periods of stress without necessitating dollar intermediation. In the Middle East and Africa, Beijing has leveraged debt restructuring negotiations to advance renminbi usage. For example, in Kenya and Ethiopia, distressed dollar-denominated debts are being refinanced in renminbi, binding these economies closer to Chinese trade networks and reducing servicing costs through lower interest rates and reduced volatility. This approach not only enhances China's influence in strategic regions, but also fosters a multipolar monetary order, where the renminbi serves as a viable alternative for sanctioned or dollar-vulnerable states. Turkey's launch of its first renminbi clearing bank in Istanbul in November 2025 marks another milestone, promoting local currency use in bilateral trade and investment, thereby diversifying away from dollar exposure amid regional instabilities. Within the BRICS framework, this momentum is amplified, with members like Egypt confirming increased local currency settlements in July 2025, and overall BRICS trade surpassing $244.8 billion in 2024, much of it in non-dollar denominations. Such alliances reflect a broader realignment, where geopolitical alignments drive financial innovations, potentially fragmenting the global payments landscape and challenging the efficacy of Western-led sanctions regimes. Economically, the promotion of renminbi in international transactions yields tangible benefits for trading partners while subtly reshaping global reserve dynamics. By encouraging diversified reserve holdings, China incentivizes central banks to incorporate renminbi assets, as seen in the Bank for International Settlements Triennial Survey, indicating a steady rise in renminbi's share in global foreign exchange turnover. This diversification reduces reliance on dollar intermediaries, lowering transaction costs, estimated to drop by up to 75% in some Middle Eastern energy trades through digital renminbi platforms, and mitigating risks associated with U.S. monetary policy fluctuations. Offshore entities have raised nearly RMB 120 billion in panda bonds and RMB 667 billion in dim sum bonds in the first 3 quarters of 2025, signaling growing investor confidence in renminbi-denominated instruments. Moreover, the integration of digital renminbi into cross-border systems, such as the mBridge project involving 23 central banks, compresses settlement times to seconds, enhancing efficiency in ASEAN and Middle Eastern trade corridors where 38% of global trade volumes could soon bypass SWIFT. In practical terms, this has enabled seamless payments in initiatives like the China-Indonesia, 2 countries, 2 parks project, where digital renminbi settlements occur in under 10 seconds, a 100-fold improvement over traditional methods. For emerging markets, this shift promises reduced borrowing costs and greater stability, as evidenced by Thailand's inaugural oil settlement in digital renminbi, which circumvents dollar volatility. However, these advantages are counterbalanced by structural dependencies, where increased renminbi exposure ties economies more closely to China's policy cycles, potentially amplifying transmission of shocks from Beijing's domestic adjustments. Notwithstanding these gains, the acceleration of renminbi internationalization introduces concealed risks that could reverberate through global financial systems, necessitating vigilant monitoring. Mismatches in currency exposures pose a primary concern for international banks, as the rapid growth in renminbi lending, quadrupling to over RMB 3.4 trillion in external loans, deposits, and bonds over the past 5 years, creates imbalances in balance sheets accustomed to dollar dominance. Global institutions holding renminbi assets may face liquidity challenges during stress events, particularly if China's capital controls limit convertibility. Shifts in capital flows, driven by renminbi's expanding role, could exert downward pressure on emerging market currencies, exacerbating inflationary pressures in import-dependent economies and triggering capital outflows. For instance, as central banks in the Global South incrementally boost renminbi holdings, from 24.6% to 27.9% in a basket of currencies between 2022 and 2025, dollar liquidity in peripheral markets may thin, heightening vulnerability to U.S. tourist rate hikes. Furthermore, the proliferation of digital renminbi platforms, while efficient, raises interoperability issues with existing infrastructures, potentially leading to fragmented payment networks that complicate cross-jurisdictional oversight and anti-money laundering efforts. In regions like Africa, where renminbi-denominated debt restructurings bind borrowers to Chinese ecosystems, this could undermine fiscal sovereignty, as lower immediate costs mask long-term leverage asymmetries. These risks are compounded by the renminbi's managed exchange rate regime, which, while stabilizing, distorts market signals and invites retaliatory measures from trade partners concerned about undervaluation, estimated at around 30% based on purchasing power parity assessments. Market behavior as of late 2025 vividly illustrates the gathering acceptance of these initiatives, with the yuan's sharp appreciation against the dollar since November serving as a barometer of shifting sentiments. The offshore yuan has climbed past the psychologically significant 7 threshold, reaching levels not seen since September 2024, buoyed by a weakening U.S. dollar index amid Federal Reserve rate cuts and robust demand from Chinese exporters. This strengthening, with the central parity rate advancing to 7.0392 against the dollar on December 26, reflects not only policy support from the People's Bank of China, but also investor confidence in renminbi assets amid China's stimulus measures and stock market rally. Concurrently, the RMB Internationalization Forum 2025 has highlighted strengthened financial ties, such as with Sri Lanka fostering cross-border trade in local currencies. Yet this momentum belies underlying fragilities. Forecasts suggest the yuan's strength beyond 7 may be transient, potentially reverting to around 7.03 by end 2026, as external pressures like U.S. tariffs resurface. The broader implication is a reconfiguration of global capital patterns, where renminbi's ascent erodes dollar seigniorage and prompts reserve managers to recalibrate portfolios, potentially heightening volatility in Treasury markets. As China's 15th five-year plan continues to prioritize stability and modernization, including extensions of equipment renewal initiatives valued at RMB 3 trillion, the renminbi's trajectory will increasingly influence international economic equilibria. This unfolding scenario warrants proactive assessment of exposure risks for multinational entities, as the renminbi's integration deepens, altering the calculus of global finance in real time. In the midst of intensifying global monetary realignments as of December 26, 2025, the United States has mobilized a multifaceted array of strategic responses designed to safeguard the dollar's hegemonic position within the international financial system. These initiatives, emerging in direct counterpoint to accelerating de-dollarization efforts by actors such as China and BRICS nations, reflect a calculated blend of legislative innovation, monetary policy adjustments, and diplomatic maneuvers. Central to this framework is the enactment of the Genius Act in July 2025, formerly known as the Guiding and Establishing National Innovation for U.S. Stablecoins Act, which establishes a comprehensive regulatory regime for USD-pegged stablecoins. This legislation, signed into law by President Donald J. Trump on July 18, 2025, after passing the Senate with bipartisan support, delineates pathways for both bank and non-bank entities to issue payment stablecoins under federal oversight, thereby extending the dollar's reach through digital channels. By mandating that stablecoin issuers maintain high-quality reserves, including U.S. Treasury securities and central bank deposits, the act not only enhances the accessibility of dollar-denominated assets in emerging markets, but also mitigates risks associated with unregulated crypto ecosystems. As implemented, it has facilitated the approval of federal qualified non-bank payment stablecoin issuers, with the Federal Deposit Insurance Corporation, FDIC, issuing proposed rulemaking in December 2025 to streamline application procedures, ensuring that these instruments can seamlessly integrate into global payment networks. This move directly addresses the erosion of dollar utility in cross-border transactions, where alternative currencies like the renminbi have gained traction by promoting stablecoins as efficient, low-cost vehicles for remittances and trade settlements, particularly in regions vulnerable to financial exclusion. Complementing this legislative thrust, the Federal Reserve has intensified its operational toolkit to fortify dollar funding markets, deploying mechanisms that ensure liquidity provision amid geopolitical volatilities. As detailed in the Federal Open Market Committee (FOMC) minutes from October 2025, the Fed has maintained open market operations to keep the federal funds rate within a targeted range of 3.75 to 4%, while expanding standing repurchase agreement (repo) facilities to alleviate strains in short-term funding markets. These standing repo operations, operational since 2021, but scaled up in response to 2025's market pressures, allow eligible counterparties to access dollar liquidity against high-quality collateral, thereby preventing spikes in borrowing costs that could undermine confidence in the dollar's stability. Furthermore, in December 2025, the Fed announced technical purchases of short-dated Treasury bills to manage reserve levels, a move aimed at countering liquidity shortages exacerbated by global shifts away from dollar-denominated assets. This initiative, projected to inject over $500 billion into the system by mid-2026, underscores the central bank's proactive stance in preserving the dollar's role as the primary medium for international reserves, where foreign holdings of U.S. banknotes alone exceed $1 trillion as of the first quarter of 2025. Such programs are integral to maintaining the dollar's attractiveness in global trade, where over 80% of transactions remain dollar-invoiced despite incremental diversification by central banks in emerging economies. Geopolitically, these U.S. responses are rooted in acute apprehensions over the diminishing scope of American influence, as the weaponization of financial sanctions has inadvertently catalyzed the development of parallel monetary architectures. The imposition of extensive sanctions on entities in Russia, Iran, and increasingly China since 2022 has prompted sanctioned nations to accelerate local currency settlements and digital payment systems, thereby eroding the dollar's coercive leverage. In reaction, the Genius Act and Fed liquidity facilities serve as bulwarks, extending dollarization through stablecoins to regions where traditional banking access is limited, such as in Latin America and Africa, where stablecoin adoption has surged by 40% in 2025 alone. This strategy aligns with broader U.S. efforts to reinforce alliances via economic incentives, including the expansion of dollar swap lines with key partners like the European Central Bank and the Bank of Japan, which have been renewed and enlarged to cover potential liquidity shortfalls amid trade disruptions. However, this approach acknowledges the paradoxical outcome of prior policies. Sanctions intended to isolate adversaries have instead fostered resilience in alternative systems, as evidenced by the BRICS bloc's expansion of non-dollar trade to over $244 billion in 2024. The U.S. administration's discussions in November 2025 on further dollarization measures, including incentives for stablecoin integration in bilateral aid packages, illustrate an adaptive posture aimed at reclaiming narrative control in a fragmenting global order, where trust in U.S.-led institutions is under strain from isolationist tendencies. Economically, the core objective of these interventions is to perpetuate the dollar's reserve currency status, which confers substantial advantages including reduced borrowing costs for the U.S. government and significant seigniorage revenues from global dollar usage. The dollar's dominance enables the Treasury to finance deficits at lower interest rates, with yields on 10-year Treasuries averaging 3.8% in 2025, despite fiscal expansions exceeding $2 trillion annually. Seigniorage, derived from the difference between the face value of currency and its production cost, generates approximately $100 billion yearly for the U.S., funding that would otherwise require taxation or borrowing. By embedding USD-pegged stablecoins into international finance via the Genius Act, the U.S. aims to capture a share of the burgeoning digital asset market, projected to reach $10 trillion in transaction volumes by 2030, thereby offsetting losses from de-dollarization in commodity trades. Fed programs further support this by stabilizing funding markets, as seen in the improved liquidity metrics post-April 2025 strains, where Treasury market depth rebounded to pre-2023 levels. Yet these efforts are not without internal tensions. The integration of stablecoins requires harmonization with existing banking regulations, and non-bank issuers face stringent capital requirements that could stifle innovation if not calibrated precisely. Beneath the surface of these strategic deployments lie profound risks that could exacerbate systemic vulnerabilities and undermine the very hegemony they seek to protect. Policy misalignments, particularly between aggressive trade measures and financial stabilization efforts, risk alienating key allies and accelerating financial fragmentation. The escalation of tariffs in October 2025, including proposed 100% duties on select Chinese imports and broader levies on trading partners, has prompted retaliatory actions from the European Union and Canada, straining transatlantic economic ties and diverting capital flows toward non-dollar haven. As this trade aggression, framed as a tool for national security, has paradoxically bolstered adversaries' resolve to pursue de-dollarization, as seen in China's intensified renminbi promotion in Belt and Road projects. Such dynamics foster a multipolar currency landscape, where fragmented payment networks could lead to inefficiencies in global clearing, increasing transaction costs by up to 20% in affected corridors. Moreover, heightened volatility in U.S. Treasury markets looms as a direct consequence. Analyses from the Office of Financial Research's 2025 annual report highlight that abrupt shifts in reserve holdings could spike yields by 50 basis points, complicating debt servicing amid a national debt surpassing $35 trillion. The erosion of global trust, amplified by erratic policy signals, may precipitate sudden capital outflows, with emerging markets bearing the brunt through currency depreciations and inflationary surges. While the dollar retains its preeminence, accounting for 58% of global reserves as of mid-2025, these risks underscore the precarious balance required to navigate an era of geoeconomic competition, where missteps could hasten a transition to diversified monetary equilibria. Current intelligence assessments, drawing from real-time market indicators and diplomatic channels, affirm the dollar's enduring dominance, but caution against complacency in the face of mounting pressures. The Fed's 2025 edition report on the dollar's international role notes that despite incremental de-dollarization in bilateral trades, the currency's share in foreign exchange turnover remains above 88%, bolstered by the Genius Act's facilitation of stablecoin proliferation. Nonetheless, ongoing tariff escalations, which have reshaped supply chains and inflated import costs by an average of 15% in affected sectors, may inadvertently reinforce alternative alliances, such as the expanded BRICS payment mechanisms. This interplay demands continuous recalibration of U.S. strategies, incorporating scenario planning for potential liquidity crises and enhanced coordination with multilateral institutions to mitigate fragmentation. As these responses unfold, stakeholders must prioritize resilience in portfolio allocations, hedging against currency mismatches that could amplify shocks in an interconnected yet divided financial architecture. The trajectory ahead hinges on the efficacy of these measures in restoring confidence, amid a landscape where geopolitical frictions increasingly dictate economic outcomes. As the geopolitical and economic tensions between major powers intensify on December 26, 2025, the intricate interplay between China's aggressive de-dollarization initiatives and the United States' defensive countermeasures is precipitating profound ripple effects throughout international financial systems, manifesting in heightened currency fluctuations and fundamentally altered investment patterns that threaten systemic stability. This dynamic, characterized by Beijing's push to elevate the renminbi's global role through expanded local currency settlements and digital payment infrastructures, clashes with Washington's efforts to reinforce dollar hegemony via legislative reforms like the Genius Act and enhanced Federal Reserve liquidity provisions, creating a volatile environment where market participants grapple with unprecedented uncertainty. Recent data underscores this turbulence. The offshore yuan has appreciated sharply, breaking past the critical 7 per dollar threshold for the first time since 2024, with gains accelerating since late November to approximately 4.6% year-to-date, driven by robust inflows into Chinese equities and a weakening U.S. dollar index that has declined over 9.5% in 2025. This yuan strength, evidenced by the People's Bank of China setting its daily reference rate at the strongest level since September 2024, signals a broader shift in investor confidence away from dollar-denominated assets. as global funds redirect capital toward renminbi instruments amid China's stimulus-driven stock market rally and equipment renewal programs valued at trillions of renminbi. Concurrently, the US dollar's depreciation, its most significant half-year drop in over 5 decades, amounting to about 11% in the first 6 months of 2025, has amplified volatility in foreign exchange markets, with the dollar's share in global SWIFT payments holding steady but under pressure from rising alternatives like the Yuan, which now captures 3.5% of international transactions, up from 2% in 2023. These fluctuations are not isolated. They reverberate through commodity pricing, where de-dollarization in trades, such as those within BRICS nations exceeding $244 billion in non-dollar denominations in 2024, disrupts traditional hedging strategies and elevates costs for dollar-reliant importers. Investment patterns are similarly transforming, with institutional portfolios pivoting toward diversified holdings, including increased allocations to gold, which has surged past $3,900 per ounce in 2025, reflecting a historic reversal where central banks now hold more reserves in gold than in U.S. Treasuries for the first time in decades. This reallocation, driven by perceptions of U.S. fiscal vulnerabilities including a national debt surpassing $35 trillion and annual deficits of $1.8 trillion in fiscal year 2025, underscores a cautious retreat from dollar assets, potentially constraining U.S. borrowing capacity as foreign demand for treasuries wanes. In this context, the yuan's ongoing appreciation as of December 2025 serves as a potent indicator of eroding confidence in the dollar's supremacy, with implications that extend to diverting substantial capital flows from U.S. assets and thereby elevating borrowing costs for the American government at a time when fiscal expansion remains unchecked. The yuan's climb, extending gains for a third consecutive session to multi-year highs around 7 per dollar, is bolstered by the People's Bank of China's acquiescence to market bulls through stronger fixings, contrasting with earlier interventions to curb rapid gains and highlighting Beijing's strategic tolerance for controlled strengthening to enhance export competitiveness while insulating against external shocks. This currency momentum, projected to yield the yuan's best annual performance in half a decade, coincides with a slump in the dollar influenced by Federal Reserve rate cuts totaling 75 basis points in 2025, bringing the federal funds rate to a range of 3.5 to 3.75% by December, and fostering an environment where investors chase higher yields in renminbi-denominated bonds and equities. Consequently, capital diversion is accelerating, with international central banks tilting away from dollar reserves, holding their share steady at around 56.3% in the second quarter of 2025 when adjusted for exchange rate effects, yet incrementally increasing allocations to alternatives amid geopolitical frictions. For the U.S., this translates into rising Treasury yields. The 10-year benchmark, dipping slightly to 4.134% in late December amid stronger-than-expected GDP data, nonetheless reflects underlying pressures from reduced foreign inflows, potentially adding 50 basis points to yields in stress scenarios, as outlined in the Office of Financial Research's 2025 annual report. Such elevations in borrowing costs compound the challenges of financing a $590 billion net marketable debt issuance in the October-December quarter, straining fiscal sustainability and amplifying the transmission of monetary policy divergences across borders. Moreover, the dollar's pullback has exposed unhedged U.S. exposures, as seen in early 2025 equity drawdowns where currency weakness magnified losses for non-U.S. investors, prompting a reevaluation of portfolio strategies in favor of multipolar currency baskets. Geopolitically, this evolving confrontation is cultivating a multipolar monetary landscape that fragments traditional payment networks, thereby heightening the risk of exacerbating crises in vulnerable regions where economic interdependencies are most fragile. The transition toward currency multipolarity, accelerated by U.S. sanctions that have paradoxically spurred alternative systems like China's cross-border interbank payment system and BRICS-led local currency frameworks, is reshaping global financial architectures along geopolitical lines, potentially raising transaction costs by up to 20% in fragmented corridors and weakening established safety nets. In emerging Asia and Africa, where de-dollarization trends are pronounced, The proliferation of bilateral swap lines and digital renminbi platforms creates parallel ecosystems that bypass SWIFT, fostering resilience for sanctioned entities, but introducing interoperability challenges that could disrupt cross-jurisdictional flows during liquidity squeezes. For instance, the US dollar's co-movement with market volatility shifted to negative in April 2025, signaling a departure from its historical safe haven status and exposing regions like Latin America to amplified shocks from policy divergences, such as US tariff escalations that reshape supply chains and inflate import costs by 15% in affected sectors. This fragmentation undermines globalized systems, as evidenced by the International Monetary Fund's analysis indicating that while a multipolar order may persist, it risks disorderly transitions that fragment safety nets and elevate geopolitical risks, particularly in debt-distressed nations negotiating restructurings in non-dollar currencies. The European Central Bank's safeguards in digital euro designs further illustrate this divide, preserving banks' intermediation roles while highlighting the challenges of maintaining monetary transmission in a landscape where US-led institutions face declining trust amid ISIL. Asianist policies. In the Middle East, oil settlements increasingly in yuan or euros dilute dollar dominance, potentially triggering regional instabilities if liquidity mismatches arise during escalations, binding economies tighter to multipolar alliances and diminishing the efficacy of Western financial leverage. Economically, prevailing market behavior reveals deepening concerns over reserve diversification, as central banks methodically reduce dollar holdings, a trend that could magnify inflationary pressures in import-dependent economies reliant on stable dollar access for trade financing. International Monetary Fund data from the second quarter of 2025 show the dollar's share of allocated reserves holding near 58%, yet exchange rate-adjusted declines indicate a subtle erosion, with central banks accumulating gold at record paces, surpassing U.S. Treasury holdings for the first time in decades, and incrementally boosting non-dollar assets to hedge against U.S. policy volatility. This diversification, encompassing over $1 trillion in foreign-held dollar banknotes, but facing headwinds from a weakening dollar, prompts reserve managers to recalibrate portfolios, potentially heightening Treasury market volatility and transmitting inflationary impulses through elevated import prices in nations like India and Turkey, where currency depreciations have compounded cost-of-living strains. Emerging market debt, particularly hard currency segments, has seen tighter spreads in October 2025 amid rebounding global liquidity, yet underlying risks persist, with overborrowing feedback loops in domestic banking systems amplifying vulnerabilities if dollar liquidity tightens further. In Angola, for example, dollar bond tumbles in April 2025 triggered margin calls pushing yields near 15%, exemplifying how financial volatility, exacerbated by reduced U.S. aid and policy shifts, threatens solvency in commodity exporters. Broader inflows into emerging market debt, supported by increasing foreign exchange reserves and risk-on sentiment, offer temporary buffers, but the strengthening case for these assets hinges on policy resilience amid higher tariffs, which could negatively impact trade-exposed economies despite their reduced direct exposure. The Bank for International Settlements' assessment of a weaker dollar's implications highlights how domestic balance sheet depreciations in emerging markets can tighten financial conditions, reducing risk-taking and curtailing credit growth, thereby perpetuating cycles of inflation and stagnation in import-reliant regions. Concealed within this shifting paradigm are substantial hidden risks, including acute liquidity shortages in dollar-denominated debts that disproportionately burden emerging markets, alongside the specter of abrupt capital outflows precipitated by diverging policy trajectories between major economies. Emerging market sovereign debt, evolving with increased domestic absorption by local banks, heightens the peril of adverse feedback loops where overborrowing erodes fiscal buffers, as detailed in the International Monetary Fund's Global Financial Stability Report, potentially leading to contagion if external funding dries up amid U.S. rate adjustments. Liquidity risks are particularly pronounced in dollar-heavy portfolios, where mismatches, exacerbated by the dollar's 11% devaluation in early 2025, could trigger sudden stops, as witnessed in historical precedents but now amplified by de-dollarization's pace. Central bank swap lines, while offering lifelines to non-U.S. banks during crises, face limitations in a multipolar setup, where fragmented networks complicate access and elevate costs, potentially leaving emerging economies exposed to margin calls and yield spikes akin to Angola's experience. Abrupt capital outflows, triggered by U.S. tariff hikes or Federal Reserve pivots, such as the anticipated 25 basis point cut in December, could deplete reserves in vulnerable nations, with net flows into emerging market debt rebounding in the third quarter but remaining sensitive to global sentiment shifts. These outflows, estimated to amplify losses through unhedged exposures, underscore the need for enhanced hedging mechanisms, yet in a de-dollarizing world, such tools become scarcer, fostering environments ripe for cascading defaults in high-debt jurisdictions. Notwithstanding these mounting pressures, the dollar's dominance endures, as affirmed by its commanding 88% share in global foreign exchange turnover and over 58% in reserves. Yet the rapid acceleration of these transformative changes demands unwavering vigilant monitoring to avert broader instability that could unravel the fragile equilibria sustaining international finance. The Federal Reserve's 2025 report on the dollar's international role emphasizes its persistence as an anchor, with foreign holdings exceeding $1 trillion in banknotes, but acknowledges incremental de-dollarization in BILA. Terrell trades that chips away at this foundation. As 9 of the 10 major central banks eased policy in 2025, delivering the most significant collective rate reductions in over a decade, this synchronized action has temporarily buoyed markets, but masks underlying fragilities in a multipolar context where currency volatility, such as the GBP/USD projected dip to 1.36 by year-end, could ignite chain reactions. The struggle to reshape the international monetary system, progressing slowly amid geopolitical realignments, risks a fragmented order that weakens global safety nets, necessitating proactive intelligence assessments to track indicators like Treasury yield curves and reserve compositions in real time. For stakeholders, this entails recalibrating exposure strategies, incorporating scenario analyses for liquidity crises, and fostering coordination with multilateral bodies to mitigate the fallout from policy misalignments. As the trajectory of this monetary evolution continues to unfold with potentially irreversible consequences for global economic architecture.